Good afternoon. Today we'll look at an interesting topic, an accounting standard number 16, IAS 16. I think it is important whether you are an accountant working in an organization or you are a student writing an exam at whatever level to appreciate the application of the various accounting standard. The knowledge of such accounting standard will help you to pass an exam, will also help you to treat the asset in that company accordingly. So today we'll begin by looking at IAS number 16, which is property, plant, and equipment. You want to understand what IAS 16 states. My names are Winfred Mpakas Sirumbwe, your lecturer for today. Thank you so much. Like I've mentioned, we are looking at property, plant, and equipment, which is commonly referred to as PPE. So PPE is a class of asset which include land and building and machineries. Now, let's go a bit in detail. So assets which are accounted for under IAS 16 include the following. But before we begin to speak, let me mention, it is important when you find a question talking about the accounting treatment of assets, or when you see assets on the trial balance or on the balance sheet, it is not ideal for you to straight away begin to do the computation. No, the first thing you must ask yourself is that what category of asset do I have? If you understand them, you must secondly ask yourself which accounting standard help to treat this asset, or which accounting standard treat that kind of an asset, because all the assets that you see on the balance sheet, they are treated according to specific accounting standard. So if you ask yourself those questions, then it becomes very easy for you to begin to do the computation or to begin to do the adjustment in the balance sheet or trial balance. So today we are saying the assets that are accounted for under IAS 16 are land and building, motor vehicle, equipment. Now, there is a condition: provided they are held for use in production or for rentals or for administration. What do we mean? Someone can have 2 housing units. Someone can have 2 properties. So you can have a house in Matero which you are using to get rentals, or where you are staying in, or where your managers, your accountant, or employees are staying in. You can also have another house in Emersdale which you are using for capital appreciation, so that after it appreciates in value, then you resell. You can also have another house in Charara which you are using for lease. These assets are accounted for differently by their same what? Building. So now, if you have a house which you are using for rentals, which you are using for an office, which you are using for manager to stay in, which you are using for the purpose of getting rentals, then those assets are accounted for under IAS 16. Very, very important. If you have motor vehicles which you are using to drive for work or to carry goods and services for the purpose of administration, which you are supporting, they are like, those assets are supporting your business for support services, then that motor vehicle is accounted for under IAS 16. If you are working for Toyota Zambia and their assets which are held for sale, those assets should not be treated as a property, plant, and equipment, because those assets are held for sale and they are accounted for as inventory under IAS 2. Very, very important. If you have got office equipment that you're using for photocopying, to do administration, what are not for leases, those assets are held for under IAS 16. Very, very important. Secondly, we are saying IAS 16 property, plant, and equipment, it does not include inventory, like I've said. Inventory are those assets which are held for the sale. It does not include biological assets, which are governed under IAS 41. Biological assets, we are saying those assets like for example, you have you have cows that you are keeping for breeding, so that they can able to give you either milk, they can be able to it's for farming purpose. Those are treated for IAS 41 biological assets. If you have assets that you are using for capital appreciation to resell, like I've mentioned earlier, those assets are accounted for under IAS 40 as the investment. It's possible you can have one property where one side you are using it for capital appreciation and the other side you are using it at an office. Now, these assets should be, this portion of assets should be accounted for differently, provided you are able to separate and they can be sold separately. For example, you are sure to say, okay, it's possible that I can sell the top wing. Maybe it is 4th floor, and then you are sure to say, no, first and second floor I can able to sell separately, I remain with this. Then if that is possible, then treat the part which you are using, the part of the asset which you are using for administration under IAS 16, and the part which you are using for leases or for sale, you can treat that as an investment. Get me right. If you have one asset which are being used separately, then you must ask yourself, is it possible that this asset can able to be separated, so that I can sell this and this part remained? If that's possible, well and good. Now, if the insignificant part of the building is being used as administration, maybe just one office, the rest of the building is used for capital appreciation or for this, then the whole property should be accounted for under IAS 40. Very, very important. Let's talk about now recognition. How do you recognize property, plant, and equipment? We're saying you only recognize that in your books of accounts if you know that the future economical benefits are probable. When we say probable, it's more than 50%. You're almost 100% sure, meaning you don't just pick any asset and put on a balance sheet. You don't just pick any asset and begin to say this is the property, plant, and equipment. No, you must first ask yourself, is the organization going to benefit from this asset? Is there some benefit that are driving to the company from this asset? Then if the answer is yes, then pick. We're saying probable, no doubt. Then the cost can be measured reliably. If you have built a house, you've built a house, but you don't know the cost, then you cannot put it under the balance sheet. You can't treat it under property, plant, and equipment because that asset, the total cost is not known. You are saying reliably measured, no doubt. Meaning you're able to know that the total cost is so much. Then you can able to go ahead and treat that asset under PPE. We're saying now, initial recognition, meaning when the asset is just bought or when the house is just built, what cost do you put in your balance sheet? What cost do you put in your books of account? Number one, I'm saying initially should be recognized at cost, meaning you gather all the total costs that are associated to build that house, that are associated to what? To buy that asset. Then that cost is the one that you recognize in your books of account. These costs include the purchase cost, the price at which you bought that asset, import duties, maybe if you paid some custom duties there, you add, and any other cost that are needed to what? To assemble that asset to become usable. For example, if you buy a plant, an equipment which requires you to go and install it somewhere, for you to install it to become usable, like for example the chigayo, like a milling plant. All those costs that are needed for you to assemble that part, bring to usable, you add them and they form part of that cost. Then together you add, and that forms part of the cost of that PPE. Very, very important. Now, imagine now you've recognized it. Now, in the second year, what you do, because at first you were just adding cost. Now remember that these assets, as you are using them, they begin to lose value. Meaning you begin to lose value in terms of depreciation and impairment. So now we're saying subsequent measurement, meaning after you've already measured it at cost, how should you measure it in the second year? That's subsequent. So now saying subsequent, meaning a company can choose between cost model or evaluation model. Now, what is cost model? Cost model is where now that cost which you had adjusted, those costs which you added together, a purchase price, assembly, duties, custom duties you added together, maybe it was 1 million. Now that you need now to factor in depreciation, because if an asset has been used for a period of time, it is losing value, meaning an organization is driving the economical benefit. So that portion should be recognized, which is the depreciation. So you remove it. When you remove it, if it's in year 1, in year 2, meaning the previous depreciation plus the current depreciation, they form what we call accumulated depreciation. You also take note. It could be there could be impairment. Impairment is whereby you have an asset which was bought at 1 million, and now you've charged depreciation in year 1, which is 100,000. So according to your books of account, your asset value or book balance is 900,000. Now, when you take it on the market, you want to sell it, or you want to sell it. Now, the market value they are saying is 800. So there's a difference between your accounting, what you are recording in your books of account as book value, and what that asset can able to be sold out. Remember, in your books of account, you've subtracted 100,000 as depreciation, so the balance is 900. But in terms of in terms of the value outside there, when you want to sell it, for example, you are saying it is catching 800. Meaning, so what is the difference? The difference is what we call impairment. We'll talk about impairment under IAS 36 later. We'll talk about impairment. So what we look into details about the impairment. But the impairment, that is the basic explanation. Then the company also has got an option to choose the revaluation mode. The revaluation mode is carried at its fair value at the revaluation date, less any subsequent accumulated depreciation or subsequent accumulated impairment. Sometimes you can have a building which was depreciated, and maybe in the book balance it was 5 million, and now that asset, because of probably like you are built a house, because now the government has put a road near your property, now the property has gained value. So meaning that that property, the value has gone up. So what you do now, that next value, which has the revalued amount, if previously it was 5 million, now the building is now at 7 million. So you need now to factor in the depreciation on that particular date. You remove it, and subsequent what? Impairment. I've already explained the impairment. Then you find now the value of that asset. I'm giving an example whereby the asset was at 5 million. You depreciated it. It was at 4 million. Now, because the government has put a road near your house, so your house now has gained value. Now your house is 7 million. So now that's 7 million. Now the next depreciation should be based on the devalued amount. That is what we are saying, revaluation mode. Now, when you find now there is a revaluation surplus, like I'm mentioning, it was 4 million. Sorry, it was 5 million. You removed the depreciation 1 million. It made it 4 million. Now the value has gone to 7 million. So the difference now, what we are calling revaluation surplus, that's what we are saying. It is increase in value. It is recognized under comprehensive income. Of course, you debt an asset because an asset will increase, and then the other leg goes under comprehensive income. Now, unless it is reversing the loss which was posted in under income statement profit and loss, then that should also be posted under profit and loss. We'll look at those details as we go on later. What we are saying, the increase should be posted under comprehensive income, and the loss, if you find that there is a revaluation loss, then that should be posted under profit and loss. Now, if you posted it under profit and loss, and then the next year now there is an increase, you need to post it under profit and loss to go and reverse that reduction. I don't know whether I'm getting. Let me give an example. If, for example, an asset was bought at 5 million, it was depreciated by 1 million, and is meaning the book value is 4 million. Now, after now something happens, or rather that seat is declared Chiwodia, and then the asset now goes, it has been under evaluation model, it has gone to 3 million, meaning there's a loss of 1 million. So that 1 million should be posted under profit and loss. Now, if in the next 2 years, the government also changes and says, no, we're going to put a more where this house was built, and now that house now has gained the value, it is now on 7 million. So what will happen now is that, remember, the loss was posted in profit and loss. So now this gain should go to the profit and loss to reverse that. And then the increase between what was posted, let's say in profit and loss you put 1 million, and then now the increase is 2 million. So 1 million should go under profit and loss to go and reverse that, and then 1 million different should go under comprehensive income. I believe you can able to get something. We'll go to practical example so that you really appreciate. Now, let's talk about depreciation. Under IAS 16, require that PPE with a limited useful life be depreciated over that useful life. For example, you know that land has got the infinite life, while the building, it has got the finite life, meaning these things are different. So it's possible that land can be depreciated longer than the plant. Companies can choose between depreciation method, e.g. we can use straight line. Straight line is where they're saying the asset's long life is 5 years. You just divide by the number of 5 years. Or you can use reducing diminishing method, which is also reducing method, whereby you say after you deduct the next, you remove the previous depreciation, and then you depreciate the balance. Again, you remove the accumulated depreciation, and then that is like that. Now, depreciation method should reflect the pattern in which the asset's future economic benefit are consumed. What we are saying is that when you buy a motor vehicle, a new Hilux, there is always an estimation to say, no, this vehicle in this company will expire after 5 years, meaning after 5 years, its life would have been economically recovered, meaning the company should have used it. So you don't just begin to depreciate anything. No. There should be a policy that guide how assets should be used. Depreciation expense is usually recognized in profit and loss unless it can be included in the cost of another asset. So this is you just expense the asset. So this is an introduction of property, plant, and equipment, which in the next chapter we are going to go deeper so that we can able to appreciate the various aspect that's around. So in a nutshell, we are saying property, plant, and equipment is accounted for under IAS 16. PPE. And these PPEs, it's not every asset. It includes land and building, equipment, but there is a condition. Those assets should be able to be used for purpose of production, administration, or getting rentals. I think I've explained that you can have two houses, this one is being used for this one and that one, and then this should be accounted differently. We are saying when you find anything that, even if they are motor vehicles, they are assets, they are houses, as long as they are under sale, like for real estate. Under real estate, they can have 10 houses. Those assets, the question that are they being held for sale? If the answer is yes, they are accounted for under inventory IAS 2. If they are biological assets, someone has got a farm, those assets that under there, I'm sure by this time you should have known that even cows are assets. They are also assets. They are called biological assets as long as they are held for what purpose. So those are accounted for under IAS 40. Investment. We are saying if you have properties which are the purpose for holding that asset is to resell, to gain value. Not just to resell, but we want it to regain value. Whereby you know that this year it's 15,000, next year it will be 30, then also at 30. Then that asset, do not account it for under IAS 16, but take it under investment IAS 40. Very important. We are saying recognition, you don't just recognize an asset. No, this because it's a motor vehicle, I'm driving it. No. First, you must ask yourself, is there some benefit that your company is gaining from this asset? And then you can account for accordingly. So you don't, and then there is also cost model. I mean, the cost must be able to be known. You have to know the cost, that this cost is so much. So thank you so much. We talked about initial recognition. First, initial cost, where you gather all the costs that are associated to bring that asset. Purchase price, import duties, assembling cost, you put together. Then you lump them and make the total cost. The next is that total cost which you recognize in previous year now. This year now, you need just to subtract to remove depreciation, because the asset has been used for that period. So you recognize it under cost model or evaluation model. If it's happened that asset has gained to value, then the cost model, the total cost, if it was 2 million, now it has gone to 3 million. That now begins now to be the value that you base your depreciation. Then we said we talked about also the subsequent measurement. I think we've talked about this one. We've also talked about what depreciation is. So thank you so much. You can provide a comment. My number are 0771 69 11 65. 0771 69 11 65. So you can provide a comment so we can assist each other. I thank you so much.